Hey, good morning, everybody. It's Mr. Clark here. Today's assignment is that you are supposed to take the article How to Make Money the Buffett Way, read through this article, and answer some questions. It's a little bit of a longer article, and I know Mrs. Clark has recorded some readings before this, but I'm going to take care of this one today just because there are some parts of the article that I know for a fact that you don't need to complete the assignment. So, a little bit about Warren Buffett. This is a cartoon of him. He's a real guy. He lives in, I believe it's Oklahoma today. Or he lives in Nebraska. I had the state wrong. Anyway, Warren Buffett is one of America's richest men. He's worth billions of dollars, and he's invested tons of money in the stock market. So people like to sort of study him and his habits on the stock market. So I'm going to read through this for you, and you can follow along, stop, replay parts of it if you wish. What if the bottom was falling out of the stock market and your portfolio had plunged by 10% in a week? And what if one stock in particular had seemed like a sure bet when you bought it last month? The company sells something everyone needs, is well managed, and has a consistent track record of growth. That is, until it missed Wall Street earnings expectations by a penny and got pounded down by 15% in a single day. Would you A, sell it and curse yourself for buying it in the first place? B, sit tight and do nothing until you recover your loss, then sell? C, smile and buy more? Sure, that everyone else is dead wrong. D, study and reconfirm your assessment of the company, then smile and buy more. If you answered D, you may have a future at Berkshire Hathaway, the financial juggernaut whose 76-year-old chief executive and godhead, Warren Buffett, is searching for a successor. That's because in addition to the requisite financial smarts, you'll need the sort of temperament to do what the Oracle of Omaha has long done best. Take advantage of the market's temporary insanity to stock up on sure things at bargain prices. It's a strategy that has not only helped Buffett become the second richest man in America with a net worth of $52 billion, but it has also made him the most watched and copied investor on Wall Street. Politicians from Arnold Schwarzenegger to Hillary Clinton seek to hobnob with him. And no wonder, whether through Berkshire's spiraling stock price, mutual funds that mimic his strategy, or investors aping his stock picks, Buffett has probably made more money from more stock market investors than anyone else in history. Each year, thousands of those winners and devotees make the pilgrimage to Berkshire Hathaway's shareholder meeting in Omaha, turning the event into a celebration of the man and his financial mastery. Of course, if you're not one of those people, or you answered A, B, or C to the above question, fear not. In the following pages, we tell you what it takes to invest like Buffett, whose strategy goes far beyond the simplistic buy and hold approach for which he is famous. For example, although he has described derivatives as financial weapons of mass destruction and has bashed hedge funds, Buffett has invested in both over the short term and has made hundreds of millions of dollars in the process. And while he is perhaps the world's leading expert on managing risk, a talent honed through his investments in insurance companies, he scoffs at the idea of spreading around your bets. Diversification is a protection against ignorance, Buffett says of index funds that hold hundreds of stocks, a sharp contrast with Berkshire's portfolio, in which the top 10 stocks account for more than 90% of its assets. It makes very little sense if you know what you're doing. You'll better know what you're doing after digesting the following pages, in which we plumb not only Buffett's investing style, but also those of fund managers who have learned to tweak it to their own and their shareholders' advantage. This investing guide marks half a century of Buffett investing and records the ideas of a man whose acumen seems undiminished. Yet even though Buffett says he's in excellent health, it's amazing what cherry coke and hamburgers will do for a fellow, he jokes. Buffett, of course, admits that he isn't getting any younger. And with no obvious heir apparent in place as Berkshire's next investor-in-chief, it's clear that even longtime Berkshire stockholders will eventually need to start thinking for themselves, which, after all, is what made their beloved leader so successful in the first place. And learning to think the Buffett way might even help you land a new job. Moving over to this part here, the 6 keys to investing Buffett style. The Warren Buffett the world has come to know as a plain-spoken, avuncular figure who seems more at home at a Dairy Queen in his hometown of Omaha than in a boardroom in Midtown Manhattan. Think Popcorn's Orville Redenbacher, not Wall Street's Gordon Gekko. And that same homespun charm extends to his investing persona. Indeed, the mystique of Buffett is that his small-town stock picker managed to become America's second wealthiest man largely by keeping things simple and sticking to his knitting. In Buffett speak, he stayed within his circle of competence. For instance, in the late 1990s, Buffett avoided the technology sector altogether, saying it's beyond me. But the man who downs 5 cherry cokes a day seems at ease investing in Coca-Cola. Yet in reality, Buffett's approach to picking stocks and businesses to buy outright has always been far more complicated than Buffett's public image as a buy him at a big discount value investor lets on. That's because Buffett has never been afraid to deviate from the classic definition of value investing. As a graduate student at Columbia University in the early 1950s, Buffett learned value investing at the feet of Benjamin Graham, whose 1934 security analysis is a value investing Bible. Like Graham, Buffett believes the best way to build a portfolio is to look for stocks trading at discounts to their true worth. Simple enough, but Buffett has made some adjustments to the teaching of Ben Graham. Says Jean-Marie Avellard, a famed value investor who heads the portfolio management team at First Eagle Funds in New York. Avellard adds that there are a few Buffett pronouncements where Ben must be turning over in his grave. Graham, for instance, never cared much about the quality of the stocks he invested in, as long as they were trading at a deep discount to their intrinsic value, based on a company's assets and other considerations as opposed to a stock's market value. Graham himself described as a cigar butt investor, willing to buy stocks that Wall Street tossed aside if they had a puff or two of value left in them. For his part, Buffett is much more concerned about the quality of the companies he searches for on Wall Street's bargain basement bin, which may explain his reported recent investment in Kraft Foods. Buffett has said that he would rather own comfortable businesses at a questionable price than questionable businesses at a comfortable price. Or as Buffett has put it, it's far better to own a significant portion of the Hope Diamond than 100% of a rhinestone. Many of today's value managers have come around to Buffett's thinking. Graham and Dodd wrote the Bible of value investing, but there have been other people who've interpreted that Bible, says David Winters, founder of Winter Green Advisors in Mountain Lakes, New Jersey. And Buffett's interpretation has been globally the most influential. What other attributes define the Buffett school of investing and might make you a better stock picker? Here are half a dozen that any do-it-yourselfer can find valuable. First, make money by not losing money. It's an oft-quoted Buffettism. The first rule of investing is don't lose money. The second rule is don't forget rule number 1. Buffett's greatest achievement may be that between 1965 and 2006, through 3 bear markets, Berkshire Hathaway lost value in only 1 calendar year, 2001. Even then, it still bested the Standard & Poor's 500 index. Buffett understood this math foible. If you start with $1 and lose 50% of your money, you'll be left with 50 cents. But then it takes a 100% return just to get back your original dollar. So it's best not to fall into a hole. Second, don't get fooled by earnings. Buffett has noted that the most companies define record earnings as a new high in earnings per share. But he says the fact that earnings per share are rising in itself tells you little, because it does not take into account how much shareholders have invested. The more that shareholders invest in a company, the greater its earnings should be. That's why Buffett favors a different measure of profitability, return on equity. ROE is calculated by taking a company's net income and dividing it by shareholders' equity. I'm going to skip the remainder of this part here because you really don't need this. Third, look to the future. They don't call Buffett the Oracle of Omaha for nothing. While Graham was always reluctant to predict the health of a business, Buffett makes a conscious attempt to identify companies with a good chance of continuing their success 25 years into the future. Buffett talks a lot about looking through the front window and not through the rearview mirror. Buffett peers into the future partly by attempting to calculate the current value of a company's expected future cash flows. It's his way of assessing a company's intrinsic value. Then Buffett looks for companies selling at a deep discount to that value. Often Wall Street, or Mr. Market as Buffett says, echoing Graham, realizes its error only after Buffett steps in. For example, Burlington Northern and Union Pacific, two plodding railroad stocks that Buffett recently disclosed owning, saw their shares shoot up more than 18% and 34% respectively so far this year. But he also has admitted that anyone calculating intrinsic value necessarily comes up with a highly subjective figure that will change both as estimates of future cash flows are revised as intrinsic rates move. Some investors use Buffett's inspired web calculators to try to emulate the oracle. Next, stick with companies with wide moats. Since it's risky to predict the future, Buffett always talks about favoring companies with wide economic moats. This doesn't necessarily mean that a company has to have a lock on a product or a market. Coca-Cola, for instance, certainly has competition, but Buffett always looks for companies with long-term competitive advantages that make forecasting safer. A big reason that Buffett avoided technology stocks in the late 1990s was that he could not identify any firms with a wide enough moat. So when Buffett said the tech sector was beyond me, he wasn't claiming ignorance. What he really meant was that technological advances in this sector were coming so rapidly that it was impossible to gauge with any clarity which companies and platforms would have a competitive advantage 18 months down the road. This would explain why even blue chip companies like the networking giant Cisco or the microchip manufacturer Intel never made it into Berkshire Hathaway's portfolio, even after their shares took a big hit in the 2000 bear market. When you bet, bet big. Most value investors are conservative by nature. The average manager of a value stock spreads his or her bets among 146 different stocks, according to the fund tracker Morningstar, not Buffett. The $62 billion that he has invested in publicly traded stocks is concentrated in only about 45 names. His strategy is even more aggressive than this statistic would suggest. His top 10 stock picks account for a stunning 90% of his publicly traded portfolio. This concentration is consistent with what Mr. Buffett has said in the past. Don't swing a lot, but if you do swing, swing for the fences, says Justin Fuller. Or ask Bruce Berkowitz, co-manager of the Buffett-loving Fairholme Fund in Short Hills, New Jersey. Why in the world would you want to invest in your 30th best idea as opposed to your best idea? Of course, this type of thinking takes moxie. You have to be totally confident that your best ideas will outperform the field. In the right hands, though, this risky approach can work. A quick analysis by US News using data. I'm going to skip all this part here. The last part, don't be afraid to wait. If you take the big swings in the stock market, as Buffett does, there's a big risk of striking out. Buffett's rule, don't swing that often, and don't swing at bad pitches. Buffett has quoted legendary Red Sox slugger Ted Williams. To be a good hitter, you've got to get a good ball to hit. And until Buffett gets such an investing pitch, he's more than willing to hold cash. He's understood something that people don't appreciate. Having large amounts of cash doesn't have to hurt your performance. Cash can be a strategic asset. Cash currently represents more than 18% of Berkshire Hathaway's investment allocation. This doesn't mean that Buffett doesn't want to maximize his gains at all times. Like Gordon Gekko, he believes greed is good, but like the quintessential value investor he is, Buffett believes that you have to be patient when exercising that greed. Be greedy when others are fearful, and fearful when others are greedy. I kind of skipped around in a couple of spots. You'll notice that there might be a couple of questions that you might need to look through, like this part here, these numbers, or maybe some of the pictures. Maybe this picture might be fairly helpful. So take a look at the captions for this picture.